There is an investment sitting in the S&P 500 that has outperformed almost everything else over the last 32 years. It is not a stock. It is not a sector fund. And most retirement portfolios are missing it entirely. Here is what I am talking about. Over the 32-year period, from 1994 through the end of 2025, dividend growers and initiators in the S&P 500 delivered an average annual return of 7%, according to Ned Davis Research. Companies that did not pay dividends at all returned roughly 1% annually over the same period. And companies that cut or eliminated their dividends produced a negative return. The gap between dividend growers and non-payers is 6 percentage points per year, compounded over 3 decades. That is not a small difference in portfolio outcome. That is the difference between retiring comfortably and not retiring at all. But here's what most people get wrong about this data. They look at those numbers and think they just need to buy any high dividend stock or any dividend ETF, and they will capture that outperformance. That is not how this works. The 32-year outperformance comes specifically from companies that consistently grow their dividends year after year, not from companies that simply pay a high yield. In fact, the highest yielding stocks on average have consistently underperformed dividend growers because unusually high yields are often a sign that the stock price has fallen and the market is pricing in a potential dividend cut. Let me show you what this looks like in real numbers with a specific example. In 1994, Procter & Gamble paid an annual dividend of roughly 54 cents per share. The stock price was around $14 adjusted for splits. Today, P&G pays about $4.03 per share annually, and the stock is around $171. 5 times increase in the dividend and a 12 times increase in the share price. If you had invested $10,000 in P&G in 1994 and reinvested all dividends, you would have roughly $185,000 today. And your annual dividend income on that position would be about $7,450 on an original investment of $10,000. 5% yield on your original cost basis. Now let me contrast that with a high yielder from the same era. AT&T had a yield of about 5% in the mid-1990s and was widely held by income investors. Over the following 3 decades, T stock went essentially nowhere after adjusting for the Warner Media spinoff and dividend cut. The high headline yield masked a business in structural decline. The lesson is not that you should buy P&G specifically. The lesson is that the specific mechanism that drives long-term outperformance is dividend growth, not dividend yield. And most investors optimize for the wrong one. Here is how to actually build this into your portfolio. Look for the S&P 500 dividend aristocrats. These are companies that have increased their dividends every single year for at least 25 consecutive years. There are currently about 67 of them. They span healthcare, consumer staples, industrials, and financials. They have survived multiple recessions without cutting their dividends. An ETF like Nobiel or RegL tracks this strategy. Alternatively, SCHD uses a slightly different methodology but captures a similar set of consistently growing dividend payers. A portfolio of dividend growers has been the single most consistent source of long-term outperformance in the S&P 500 for over 3 decades. And if your portfolio does not have a meaningful allocation to this category, you are missing what the data has been screaming at us for 32 years.